Welcome back to Investing Talk Podcast.
Today we're looking at Dynavax.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis, and there's really only one place we can start. A $2.2 billion validation that just completely changed the game here.
Okay, let's unpack that right away because that headline is, it's just enormous. We're talking about Sanofi stepping in to acquire Dynavax for $2.2 billion. All cash.
Right. This wasn't just another piece of news. It was a massive, immediate market catalyst.
And the market reaction was explosive.
Oh, absolutely. The stock surged nearly 39%. It hit 3-year highs almost instantly. For investors holding it, that's the kind of day you dream about.
And that premium, the $15.50 per share in cash, that's obviously a great immediate return. But the bigger question, I think, for anyone watching this space is, what does a move like this signal about the actual technology?
That's the core of it, really. You have to look past the transaction and see the strategy. When a giant like Sanofi puts that much cash on the table, they're making a huge statement.
A statement about what, specifically?
It's a profound validation of two key things. First, their main product, Heplisav-B, and second, the deep foundational IP behind their entire pipeline. They aren't just buying sales, they're buying a platform for making better vaccines.
Right, buying the innovation itself.
Yeah.
So let's talk about the fundamentals that made them so attractive. What did their health look like leading up to this?
Well, their Q3 performance for 2025 was a really clear signal. They posted earnings of 21 cents per share on nearly $95 million in revenue.
And that was beat, right?
A big beat. Wall Street was expecting something closer to 14 cents, so they were already showing really strong operational momentum, which, makes the acquisition timing make a lot of sense.
And the engine behind those numbers is Heplisav-B, the adult hepatitis B vaccine. Now, in pharma, we always talk about the moat. What's the moat for this vaccine?
The moat is huge, and it's all about patient behavior and speed. Most other vaccines in this space need 3 doses spread out over 6 months.
Which is a long time. It's easy for people to fall off the schedule.
Exactly. You see a lot of drop-off, patients who never get that third shot, and so they don't get full protection. Heplisav-B just completely changes the game.
How so?
It's just 2 doses over 1 month.
Wait, just 1 month?
Just 1 month. And that isn't just a small medical tweak. That's a massive behavioral and logistical advantage.
It's way easier to get a patient back in 4 weeks later than it is 6 months down the line.
Absolutely. So compliance goes way up. And that translates directly to the financials. You see high gross margins and critically positive operational cash flow. The core product is a cash-generating machine.
And that cash flow is what funds the pipeline, right?
Yeah.
But the thing that lets them have that 2-dose schedule, that's the real secret sauce Sanofi was after.
That is the crux of the deal. It's their proprietary CpG adjuvant technology.
Okay, let's pause there. For our listeners, what exactly is an adjuvant and why is this one so special?
So an adjuvant is basically an ingredient that boosts the body's immune response to a vaccine. Dynavax's CpG tech is a particularly powerful type of booster. It creates such a strong response that they can achieve full seroprotection.
The protection we're aiming for.
Right. They can achieve that with fewer doses in a much, much shorter time.
So if Sanofi didn't just buy a vaccine, they bought the recipe book, the IP that could potentially make their future vaccines better and faster too.
Precisely. That is the core competitive advantage. Heplisav-B is the proof of concept. It shows this platform can create products that solve real-world problems.
And that kind of foundational tech is what attracts the big money, which I guess explains the institutional ownership numbers.
The numbers are staggering. We're talking 96.96% institutional ownership. That is an incredible lockup. It shows extreme conviction.
You saw firms like SquarePoint Ops just loading up in Q2 of 2025. That's cluster buying. That's smart money seeing M&A on the horizon.
For sure. And with a manageable balance sheet and Sanofi bringing all cash to the table, it just makes for a very clean, straightforward transaction.
So Heplisav-B is the cash cow today. But Sanofi is obviously looking at tomorrow. What's the future growth engine they're buying?
It's the pipeline asset. The phase 1/2 shingles vaccine candidate, Z10018. That's the next big bet.
Okay, now that's where it gets really interesting for me. The shingles market is dominated by GSK's Shingrix. It works incredibly well. How does a new player even begin to compete with that?
It comes back to that same CpG technology, but this time the focus is on patient experience. Shingrix is very effective, yes, but it's also known for causing some pretty noticeable side effects.
I've heard that. People feel pretty rough for a day or two, like a bad flu.
Exactly, and that can cause vaccine hesitancy even if it's temporary. The thinking behind Z1018 is that it could offer similar high efficacy, but with a much better tolerability profile, fewer side effects.
So, same protection, but a gentler experience.
That's the goal. And if they can deliver on that promise, that is a massive competitive advantage. It's a potential market disruptor. That's the upside Sanofi is paying for.
Okay, so we have a dominant current product, institutional confidence through the roof, and a pipeline asset with a clear path to compete in a huge market. That brings us back to the stock chart.
And that 39% surge. It wasn't just the news. There was a technical component. Short interest was over 12% of the float.
So a classic short squeeze on top of the M&A news.
A classic squeeze. The shorts were forced to cover, which just threw gasoline on the fire and blasted the stock through all its previous resistance levels.
And technically, the chart looks quite constructive now. We're seeing multi-time frame strength and even signs of a potential golden cross.
Right, and for those who aren't familiar, a golden cross is when the shorter-term 50-day moving average crosses up and over the longer-term 200-day. It's often seen as a bullish signal that a new, sustainable uptrend could be forming.
The market mood is obviously bullish,
Yeah.
but this is where we get to the most fascinating and maybe the most confusing part of this whole story.
The price discrepancy.
Exactly. The fact that the average analyst price target is $24.33, that is significantly higher than the 1550 deal price.
It is a massive disconnect.
So let me get this straight. The experts who cover this company full-time believe it's worth over $24.
Yeah.
But the board agreed to sell for $15.50. Why? Did they sell the company too cheap?
And that's the billion-dollar question for shareholders, isn't it? You have to weigh the certainty of cash in hand against future potential.
$15.50 is guaranteed money. Today.
Exactly. That $24 target is an idealized future valuation. It assumes Z1018 is successful, that Heplicity keeps growing. It assumes years of perfect execution and navigating regulatory risks.
So the board took the risk off the table.
They took the risk off the table. They realized the immediate guaranteed value. It's a classic risk-off strategy, even if it leaves some potential upside behind.
Speaking of risk, no deal is done until it's done. We have to talk about the bear case here. What could go wrong?
Well, the number one risk is just deal failure. It could get held up by regulators. Specifically, we have to watch for HSR clearance.
Can you explain what that is?
It's the antitrust review from the FTC and the Department of Justice. They have to make sure the deal isn't anti-competitive. It's a standard step, and things seem to be pointing toward a Q1 2026 close, but it's still a hurdle that has to be cleared.
And we are seeing some grumbling from shareholders about that price, right?
We are. You're seeing some lawsuits and probes from firms questioning the fairness of the 1550 price. That's pretty common in these situations, but it does reflect that frustration that maybe, just maybe, more value is left on the table.
So for anyone watching this play out, what are the key dates to keep an eye on?
Next up will be the Q4 2025 earnings in early February 2026. That's our last real snapshot of the company's momentum. Then the tender offer should close sometime in Q1, probably by March, assuming HSR goes smoothly.
And beyond that, it's about watching what Sanofi does with the assets.
Exactly. How quickly do they integrate the CPG platform? When do we see more data on Z1018? That's the next chapter. And it's all happening against a backdrop of a lot of M&A and biotech right now.
Right. There's a real tailwind here.
A huge tailwind. Global demand for adult vaccines is soaring, and policy is shifting to favor non-childhood immunizations. Companies like Dynavax are perfect targets in this environment.
Okay, so let's bring it all together. What's the final thesis here?
I think the perspective is pretty clear. The deal gives shareholders an immediate premium capture at $15.50. But the bigger story here is the validation. It proves the long-term potential of the CPG platform, which will now have the power of a global player like Sanofi behind it. They bought the future, not just the present.
Which brings us right back to that fascinating price conflict. The certainty of the deal versus the potential that analysts saw.
Indeed. With that average analyst target still sitting so far above the acquisition price, the question for you now is, does this deal just realize immediate value and avoid future risk, or does it actually confirm that the market was fundamentally underestimating the true worth of Dynavax's vaccine technology all along?
A great question to end on. That's all the time we have for today's analysis. Make sure you subscribe to the podcast so you don't miss our next one.